It's unusual because of the calendar that the Fed would be pushing into blackout, the 10-day blackout ahead of the Federal Open Market Committee on a non-farm payroll Friday. But it just happens to be that the jobs report is one Friday later than it would normally be. So they're going to barely be able to react publicly to whatever's reported, and they'll be in radio silence mode come Tuesday when the CPI report is released. So they're going to have to position themselves to potentially raise by 0.5 percentage point very quickly if, like the case was in January, the non-farm payroll report comes in hotter than expected. I think that the dots are going to show that there is a higher terminal rate that is pushing toward 6%. That might not be what markets want to hear, but it's certainly been validated by Powell's chief lieutenants, Waller on the Federal Reserve Board, and John Williams, who is the vice chair of the Federal Reserve, Federal Open Market Committee, and president of the New York Fed. They both reiterated what Powell's saying, and that's that we're going to get rates higher than what we expected, and then we're going to maintain them throughout at least the remainder of 2023. Again, these are the Fed continues. The most important Fed officials continue to say we are going to defy the markets. And as opposed to, it's bizarre, if you will, because a year ago we would be saying, don't fight the Fed. And yet that's exactly what markets are doing these days. They're fighting the Fed, and speakers have to keep talking that back with hawkish rhetoric. I think that given how resolute Powell was in his 2-day testimony to Congress, that we should certainly be putting 6% into a base case scenario at this point, especially if we're going to be seeing a 0.5 percentage point hike come March the 22nd, because the window's definitely still open for there to be further cuts into May and into the summer. This is the first moment, if you will, where we're rounding the 1-year anniversary of the Fed beginning its tightening campaign. Silicon Valley specifically cited higher for longer in terms of why it is in distress. And the market has now begun asking two questions. Will there be a white knight? And what bank is next? So we've seen the largest move in spreads since last October. We're seeing small and mid-sized banks coming under attack, and people are beginning to ask how many banks are out there with similar levels of losses that they're sitting on that they cannot move, such that the FDIC or another regulatory entity could easily broker a marriage between a weaker bank and a stronger bank. Again, $15 billion out of a $91 billion portfolio in the case of Silicon Valley Bank. This could be a tame example. There are many other banks out there, because they're losing deposits to money market funds paying upwards of 5%. That's putting an additional pressure on the small and mid-sized banking sector. So it's very rational for investors to be asking, is there contagion in train right now? Right now, we're beginning to see, the Fed officials have been talking about the lag effect in theory. Now we're seeing what it looks like when it manifests in practice. And there are certain things that will cause the Fed to become less hawkish if it begins to look like things are going to break in the banking system, and you've got 81% of the United States population living in banks with rising initial jobless claims as of this morning's surprise data. When you combine these two things, you start to say the banking system's at risk, the real economy is at risk. It's going to be very difficult to hold a very hard line if you're Fed officials. And it started with Silvergate, but it didn't take long to bleed into another bank. That is something that the Fed, as a regulatory entity, they must heed these signals.